This is News You Can Use.
Hi, I'm Pat Flood, and thank you for joining us today. Last Wednesday, the Federal Reserve raised interest rates for the first time in 3 years, and it might just be the beginning. In fact, Fed Chairman Jerome Powell has signaled that in an effort to curb inflation, the Federal Reserve may raise interest rates by as many as 7 times in 2022. Often this news brings a bit of trepidation regarding the housing and housing finance industry. We've all experienced the perfect storm of rising home prices and historically low interest rates over the past 2 years, which has resulted in a gold rush on real estate and a surge in home refinancings. Many are speculating if the real estate party is coming to an end, as higher interest rates will lead to an increased cost to finance home purchases. Over the past 2 months, we've shared 8 different episodes of this program with special guest Doug Duncan, Chief Economist for Fannie Mae. No one has more accurately predicted the future of housing over the last 20 years better than Doug and his team of economists at Fannie Mae. During our time together, Doug repeatedly shared how the rising interest rates will severely impact the refinance business, but only marginally impact the total home purchases that take place this year. Fortunately, for you and me, we're not in the refinance business. We're in the American dream business, and business, despite the challenges of rising rates and low inventory, remains very positive. Although the total volume of new home purchases is expected to decrease by 4.1%, that's an all-time high it's coming off of. When you factor in the increase in price, the total amount in dollars of home purchases and home purchase financing is expected to increase from 1.8 trillion to 1.9 trillion in 2022. Today, I wanted to offer you a historical perspective on interest rates and on housing sales to keep the activity and the news in context. Okay, if you take consideration of the last 50 years, the average 30-year fixed rate mortgage, 50 years, the average 30-year fixed rate mortgage, just under 8% on average. So of course, the last year or two, during COVID, the Federal Reserve dropped interest rates to an all-time low to make sure the economy, stayed growing. Guess what? It worked. And guess what? It's growing almost too fast today. And so the Federal Reserve is now deciding to affect policy by raising interest rates. But it looks like we'll get back 30-year fixed rate mortgages to 4.5%, maybe 5%. Again, against a historical 50-year average of just under 8%. Make sure your customers aren't lamenting what they missed, the lowest interest rates in 50 years, for a minute. Make sure they're focused on understanding that if they get a 4.5% or a 5% or a 4% 30-year fixed rate mortgage, they're still significantly below the 50-year historical averages that likely their parents paid when they were buying homes. So keep it all in context. We're going to see interest rates increase. The Fed is going to do that to temper inflation, but in the long run, that's actually the best way to stabilize the economy and stabilize housing prices over a period of time. So, despite the increases that are expected in interest rates, the forecast for 2022, we are still enjoying a season of historically low rates, well below the average interest rates, 30-year fixed rate mortgages that we've seen over the last 50 years. The takeaway: the real estate market is open for business, and Supreme Lending is open for business. And we're ready to serve you and your customers with the best customer service and the quickest closing times in the industry. This is News You Can Use.